Hello everyone, and welcome to the latest episode of the Muni Minute. I'm Greg Warner, this is Scott McIntyre. Together we head the Investment Management Services Group at HilltopSecurities Asset Management.
The first thing Greg and I want to do is acknowledge that we were wrong the last time we spoke, which was February 19th, before everything started getting crazy. And on February 19th, inflation was pretty much in check at that point. And the Fed was in a position, because of labor market weakness, to be able to cut 2, maybe 3 times in 2026. And the likelihood of that scenario playing out was abruptly halted on the 27th, Friday night, the 27th of February, when US and Israel launched a joint attack on Iran, preemptive attack on Iran, which effectively closed the Strait of Hormuz. And what that did was it drove energy prices sharply higher very, very quickly, and took the narrative from rate cuts to, I'm not sure where we go at this point in time. Certainly rate cuts are completely off the board. At this point, we're watching energy. Energy has become the central point.
And oil prices are really what's driving that. And of course, we've seen the price of oil as a result go from, it was $55 a barrel in December to 60 to 65 in January and February. This morning, West Texas intermediate crude is trading at $107 a barrel. And that, of course, bleeds into lots of other things because all the stuff that's made from oil. Obviously, things like diesel fuel come to mind. 55% increase in the cost of diesel fuel. It's up more than $2 a gallon to a record high, $5.60 a gallon. Jet fuel is up 57% over that period of time. We're facing shortages in Europe and Asia of jet fuel. That's led Lufthansa to announce the cancellation of 20,000 flights over the next 6 months. And then, of course, you get to gasoline, which hits consumers where it hurts the most. We've seen gas prices that were less than $3 a gallon in January, now $4.50 a gallon on average across the United States. So that energy cost is really driving inflation.
And energy is about 40% of the CPI. CPI is the measure that we all look at, Consumer Price Index. That went from 2.4%, which was January and February's headline, to 3.8% in April on an annual basis. And the expectation is by the time we get to May, CPI could be as high as 4-5%, moving very quickly higher. And obviously, the longer this goes on, the more likely it is that that's the case. The Fed's favorite or preferred inflation measure is PCE. And PCE core is about 3.2%, so that's up from 2.6%. It's still pretty much in check, but this isn't anywhere close to over.
Let me jump in here, Scott, because you mentioned core PCE going to 3.2%. The Fed's target's 2%.
Right.
When here in February, we were heading towards 2%. Now we're clearly moving away from it and going towards 3%. And that, of course, has led to a big change in bond yields. The bond market has really had to shift gears. We saw the 2-year Treasury, which on February 27th traded to its recent low at 3.38%. This morning, we're at 4.13%.
Right.
So we're up 75 basis points on the 2-year Treasury. That tells us that the prospect of rate cuts has completely shifted. And in fact, rate hikes is a prospect that markets are now thinking about. We've also seen longer-term bond yields rise dramatically. The 10-year Treasury yield has gone from 394 to 467. So it's basically mirrored that 75 basis point increase. And then the 30-year Treasury, which is really a concern when you talk about the national debt, has gone from 461 to 520. It's the highest it's been since 2007.
Right. So the Fed controls the short end of the curve. When they lower interest rates or raise interest rates, is the overnight rate. The longer end of the curve responds to a number of different things, and one of them is inflation expectations. So not only do we have inflation that's moving higher now, but the market expects that inflation is going to continue to move higher. And that's not a domestic thing, that's a global thing. It's happening all around the world. And interest rates are rising all around the world. And central banks around the world are having to raise interest rates. Now, we're on pause for now, but the longer this goes on, the more likely it is that the Fed may have to pivot and potentially raise rates. But there's a lot of other things that are going on. There's a lot of geopolitical uncertainty. Obviously, global yields are rising in response to that, but the national debt is increasing.
Big problem.
And that's a big concern. So there was $155 billion worth of Treasury securities that were auctioned last week. The auction did not go well. Investors are not excited about buying any type of debt.
Well,
and there's more and more debt that's being issued.
That seems to be a global problem because we're seeing bond yields around the world rising. And it seems like buyers are balking at some of these levels. Of course, like you mentioned earlier, unrealized losses on bonds you bought a week ago, not really all that anxious to step in and do that again.
Absolutely. And we have a new Fed chair. So Kevin Warsh took over as the chairman of the Federal Reserve on the 15th, which I guess was Friday. And he's going to have a really big job in front of him because inflation is getting hotter. You can make a case that the economy is slowing down. We talk about demand destruction. It's really difficult for the Fed to do much of anything. Right now, they're on pause. And there are some people who believe that the Fed will step in before the end of the year and potentially cut again. I think that's remains to be seen.
I think that's a bit of a stretch because I think the market's doing a lot of tightening for the Fed.
So your thoughts on the market in general going forward between now and the end of the year?
Boy, it's really a tough call here. I think the Fed is on the sidelines. Clearly, they can't cut rates with inflation running way too hot. I don't think they'll have to raise rates either, though, because I think the market has done a lot of tightening for them. I mentioned the yield curve shifting higher by 75 basis points. That's a fair amount of tightening right there. But I also think we have to really worry about, can the consumers hold up? So far, they've been able to. But as oil prices and gas prices remain this high, interest rates remain this high, it's bound to have an impact.
Yeah, so it is either demand destruction and the Fed has to cut, or inflation continues to move higher and the Fed raises rates. All of that falls on the new Fed chairman. He only gets one vote. He's going to have to be persuasive one way or another. My thought on the Fed is that they don't necessarily have to raise rates. You'd already talked about how the market was tightening for the Fed. So in other words, when interest rates rise, that is a de facto tightening going on. Kevin Warsh has talked about the balance sheet, the Fed's balance sheet being too bloated. He would like that balance sheet to be less than it is. He'd like to trim that down. He'd like to allow securities to mature. And if he does that, there's going to be more supply for the market to absorb, which really implies higher interest rates all along the curve. So again, more de facto
So he
tightening.
can tighten without actually raising the overnight Fed funds target.
And I think that is the most palatable solution because obviously the president is going to put a lot of pressure on his new Fed chairman to cut, and it's just not possible.
Either way we slice it, we've created a lot of stress both in financial markets and for consumers.
We have, absolutely.
Well, that's going to be it for us today. Thank you all for joining us.